Hello, whole team. My name is Phil Charles, and I'm a junior studying finance at Indiana University's Kelley School of Business. Today, I will use your software to tell you why you should sell Pepsi stock at its recent levels of just over $80 a share. Pepsi is a diverse company in the consumer staples sector that sells beverages and snacks all over the world. The company has 6 main business segments: PepsiCo Americas Beverages, Quaker Foods, Frito-Lay, and also its Europe, Latin America Foods, and Asia, Middle East, and Africa segments. Historically, Pepsi has achieved consistent and strong cash flow return on investment levels that create wealth well above the company's cost of capital. However, because Pepsi is a maturing company, it is experiencing a fade in its returns, which have trended downwards over the past decade, reverting back towards the industry average of just under 16%. The current valuation by the market expects Pepsi to grow its CFROI levels back up to 18.6% in 10 years. This task is far too ambitious and will prove to be an uphill battle for the company. I will further analyze Pepsi to explain why I believe this growth is unlikely and why the company is overvalued. Pepsi has seen declining operating margins over the past 10 years, as well as a declining asset turnover ratio over the past 15 years. In addition, the company grows its sales at inconsistent rates, with much uncertainty looming over the future growth prospects. Due to health concerns regarding sodas and snack foods, sales are expected to decline in upcoming years. This will be detrimental to Pepsi in that the majority of both its revenues and its profits can be attributed to the beverages and Frito-Lay segments. This leads to the unanswered question: where is Pepsi going to find drivers for future sales growth? When evaluating Pepsi, I gave the company the benefit of the doubt and was not overly bearish in its future returns, assuming that Pepsi could at least hold its current levels of CFROI, asset growth, EBITDA margins, and asset turns for the next 5 years. I did slightly increase the discount rate to account for a climbing risk-free rate after the Federal Reserve's decision to taper on its bond purchases, but I also assumed Pepsi could grow its sales at a modest 5% per year, which is just over the industry average. Even with this, I found a warranted price for Pepsi that gives a downside of 45%. In a more optimistic scenario, with steeply increasing CFRI levels and asset growth and significantly lower discount rate, we find that Pepsi's warranted price is consistent with the current market price, showing minimal, if any, upside for the stock. Holt's estimates are also bearish on the Pepsi stock, with both the high and low price targets residing well under the current price. Because the probability and magnitude of downside risks far outweigh the possibility of a small upside, it would be wise for investors to avoid Pepsi stock at this price and instead look for better, more valuable investments. Thank you for your time.